Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another weekly market recap here with my good friend Lance Roberts, who I hope is going to do most of the talking today, because as you can hear, I have a head cold that has made its way down into my throat and I don't sound very nice. Hi, Lance.
Hi, how are you? Apparently, I'm doing better than you today. So, I'll take care. You ask short questions, I'll give you long answers. We'll knock this out in no time.
Good. This is one of the times where I'm especially appreciative of the fact that you like to talk.
My wife never says that.
I do have a long list of questions. I'll try to keep them short.
All right.
And let's start actually with the week's action for the market. Didn't seem to go very much anywhere this week. And I'm wondering, apropos of our theme from last week, is reality beginning to set in the market? We talked about the market maybe, seeing what it wanted to see or hearing what it wanted to hear in Jerome Powell's comments, and it might be sort of waking up the morning after and saying, maybe we partied a little bit too hard last week. What do you think?
No, not at all. So the answer to your question is yes, but the market didn't come to its own conclusion. This happened on Monday. So, on Friday, last Friday when we were talking about this, we'd had the CPI, the previous CPI report, the market had jumped 5.5% on that. And then Jerome Powell last week had the speech at the Brookings Institution and made it very clear. He says, hey, look, we're going to slow the pace of rate hikes. And, but buried in that sentence was also, but, we're, still going to stay on our inflation hiking campaign. And, we're going to keep hiking rates. Well, the market just overlooked that and said, hey, let's run the markets up 3.1% because obviously the Fed's ready to pivot. Well, and then on Monday, Nick Timiraos, who is the Fed's, quote unquote, if you to the news, right? He's the Fed's deep throat. So, basically he gave a leak out. And of course, right now, importantly to remember, is the reason that Nick Timiraos is writing this article on Monday is because the Fed is in blackout now until the 14th of December. That's next week. So next Wednesday, when they have their FOMC meeting, then they'll make their policy statement announcement, all that. But between last Friday and next Wednesday, they're in a blackout. So the Fed speakers can't talk. So what we said last week is, and this is particularly important, last Friday we said, hey, the market, the market may be thinking about this pivot. And we talked about the fallacy of this idea of what a pivot actually is. But most importantly, the Fed is not going to like this rally because it eases financial conditions, which is exactly the opposite of what the Fed's trying to achieve. And let me step back here in history for just a moment, because we often forget about history and when we talk about things. But go back to 2010. For a minute. So in 2008, we had the financial crisis. Lehman goes into bankruptcy, and the government does the TARP, the Temporary Asset Relief Program, and the Federal Reserve drops rates to zero and starts quantitative easing part one. Markets rally in 2009. Now, that original QE program was only going to run until June of 2010. So from when it was launched in basically very, very late 2008, that QE1 program ran until June of 2010. It then ended, and that was over. I mean, it's like there was no taper off. It was just, we're going to do it to this point, and it stops. Well, as soon as it stopped, the market tanked. And as we got into September, we get into Jackson Hole, and then coming out of Jackson Hole, at the Jackson Hole Summit, Ben Bernanke, Fed chairman at that time, comes out and says basically makes the case for the Fed's third mandate. He said, I'm going to paraphrase here a bit because I don't have his quote directly in front of me. But basically what he said is that the reason that we're now going to do QE2, which was launched in September of 2010, after this decline in the markets, is because higher asset prices boost the wealth effect, which gives consumers confidence. That higher rate of consumer confidence leads to economic growth. So this is where the Fed picked up this third mandate, being their two primary legal mandates are price stability and full employment. They then picked up this third mandate kind of off the books about creating a wealth effect using quantitative easing. And it's always interesting to me is that, Ben Bernanke was very clear about the purpose of QE, which was to boost asset prices. And yet there's all these articles written by people in the mainstream media going, QE doesn't affect asset prices.
Yeah.
Okay. Who you going to believe? Anyway, another story. So here we are, flash forward now, 2010. So this is what Ben Bernanke says in 2010. So flash forward now, here's where we are. So the Fed is trying to reverse that wealth effect, because what they need to have happen is they need consumers to stop spending money in the economy. They need them to slow down the pace of demand. They need businesses to have a lack of demand, so they begin to lay off employees, begin to terminate employment. We need unemployment to come up. As you have this lack of a wealth effect and tighter monetary policy, that's going to bring down demand, which will ultimately bring down inflation. This is the whole reason for hiking interest rates and doing quantitative tightening. The Fed is trying to reverse the wealth effect that's in the markets, and this will help feed into that reduction of confidence to bring down inflation in the future. So this is every time the market rallies, it does exactly the opposite of what the Fed wants. So having said all that, coming up on next Wednesday's meeting, the Federal Reserve will announce their 50 basis point rate hike. Right now, there's no chance of a 75 basis point hike. So they're going to do 50. But the reason that Nick Timrose came out with this article on Monday that pretty much tanked the market, we've wiped out the entire post-Brookings Institution speech by Jerome Powell at this point. So we've come back down. We were kind of retesting the 100-day moving average on Wednesday. But the whole purpose of that leak was to take some of this froth out of the market. And Nick Timrose was very clear. He said, not only, these are his words, right? But these are, again, he's the deep throat for, the Fed's Watergate here. They're basically leaking him information, then he's basically converting it into his own words. But he said, look, the Fed is likely going to hike 50 basis points. There's even a possibility now that they'll hike 50 basis points at their first meeting in the new year in January. And they could potentially hike rates even further than what market participants currently expect. So this was a very clear message that the Fed is not going to pivot anytime soon. They keep trying to make that message very clear, and the bulls just keep ignoring them. It's like, oh yeah, we heard that, but you're going to pivot. And so we kind of run up stocks. But, the Fed's made it very clear that the beatings are going to continue until morale improves.
All right. So it'll be interesting to see what the Fed officials say when they come out of the quiet period here. If they're going to does Powell pull a Jackson Hole where he just tears up whatever he was going to say and just has to be real direct and give the real tough love to markets. We'll see.
I think, by the way, real quick, I think that's exactly what's going to happen. I think that Jerome Powell learned his lesson at Brookings, and he's going to come out and be very clear in this next. Well, remember, there's two parts of what happens in the FOMC meeting. There is the announcement, which is where they release their statement, which is always the same statement with minor tweaks, right? So that doesn't tell us a whole lot, but they'll hike rates 50 basis points. So we're hiking rates 50 basis points. Here's the statement. And that statement has a few little changes. Employment is weaker, or employment is stronger, or spending is stronger or weaker, or whatever. So small changes. What'll be important is what he says during the presser. And I expect him, and again, I could be totally wrong, it's just my guess, but after the Brookings speech where the markets took off, and after that leak to Nick Timrose this past Monday, I certainly expect on Wednesday he's going to come out and be very direct in a statement and say, no, we're going to hike 50 basis points. There's a chance we'll have to need to hike 50 basis points at the first meeting next year. We're probably going to have to hike rates further than expected because we're not seeing any major weakness in employment or sharp declines in inflation. So, and PPI came out on Friday hotter than expected. So again, the hope that we're going to have a very sharp drop in inflation it doesn't mean it won't occur. And I still suspect we'll see sharper rates of disinflation next year. But, there's not enough evidence on the table right now to get the Fed to pull off.
Okay. All right. I want to actually pull that thread further with you in regards to 3 interviews I just did in rapid succession this week. Real quick before we do, you had warned folks a couple months ago that we may see stocks rise into the end of the year, which we generally have, right? And I think it was just maybe last week, we had the Golden Cross, right? Which I guess is where the markets went above both the 50-day, the 200-day, and the 50-day and the 200-day moving average. They've now come back down. So what does that tell you right now, technically?
Well, technically, this is really kind of playing out to exactly what you and I talked about. I think it was maybe three shows ago that you and I did. I have to go back and check the tape. But we talked about, so two things. First of all, if you go to our website at realinvestmentadvice.com, there's a search bar at the top, and and just type in short squeeze. On September the 27th, this was at the bottom of the market on September the 27th, I wrote an article called The Big Short Squeeze is Coming, and I laid out the case for why the markets would likely rally into year end. And you and I talked about this on the show. There's three primary kind of issues for that. One is seasonality. Two is that stock buybacks were coming back online, coming out of the blackout window. And three, there's a lot of mutual funds that are underweight, and they had to get reallocated back into certain positions. We also said, though, that in the first, and then through our conversations, we talked about that we'd have this rally, but the first 2 weeks of December likely are going to be very sloppy, potentially get a bit of a sell-off here, get some sideways sloppy trade, because there's 20% of mutual funds, and basically a lot of mutual funds have to make year-end distributions. So every mutual fund every year has to either distribute out all their capital gains, they have to distribute out their dividend income and their interest income if they're a bond fund. So those have to be made. So if they don't have enough cash on the hand, they've got to sell stuff. And so that typically leads to a bit of volatility in the first 2 weeks of December. That sets you up for that year-end kind of Santa Claus rally as they window dress for the end of the year reporting. So now they got to get everything back on their books. And that's also part and parcel of why I think we saw such a very strong rally in bonds. And we talked about this before, is that when the rally in bonds came, it was going to happen very quickly. And that's what we saw. The 10-year Treasury TLTs had a very sharp rise over the course of just the last couple of weeks. And I think a lot of that is because these mutual funds that were underweight bonds had to get them back on their books because prices had come down. They were less than, if there were a 60-40 portfolio, they didn't have enough bonds, so they had to buy some. That's run those up. And of course, now after we've had this run up, I'm getting a ton of emails from people going, is it now time to buy bonds? It's like, no, I told you you're going to miss it. Now we're 3 standard deviations overbought. Right. You're going to have to just wait for an opportunity to buy some bonds at a later date. But that's the risk of trying to time a market. And I warned you, I said, when it happens, it's going to happen too quick for you to buy into it. And now, everybody's like, is it too late? It's like, yeah, it is. So you have to wait. But so I think a lot of this will subside. I do think we continue to get a little bit of a rally through the end of the year. I think you're going to get a reversal in rates. Rates came down too quickly at this point. Again, I think it's a rebalancing issue. I'm guessing, but that typically tends to spring other psychological action, right? So now everybody's like, "Oh my gosh, bonds are coming back. I better get into it." And now I'm seeing a bunch of articles being written. We've been talking about the value of bonds going into next year for the last 4 months, and now I'm seeing article after article like, time to buy bonds. Bonds are going to outperform next year. It's like, yeah, we've been saying that for, 6 months now. So welcome to the party. But anyway, this is just kind of what's happening. But everything kind of moves in directional trends. So you get a big move up there. It's going to pull back. That'll give you a better entry point. I do think we've probably seen the bottom in bonds for at least the time being. We'll have to monitor it closely. But I think between now and the end of the year, a little bit more sloppy trade through the Fed, get through that potentially. We'll see what happens. But we do have a few signals that are very concerning. The MACD signal that we have been a very good indicator this year to get you into stocks and out of stocks is on a sell signal, very clear right now. The Copic curve is also, giving some warnings. The commodity channel index giving you some warnings. So there's a lot of technical indicators that suggest that this market could have a bit more of a pullback between now and sometime in the first quarter of next year. So just, want to be a little cautious.
Okay. And that's actually a good segue into the comments from the experts I want to bring up here in just a second, but to stay on bonds for a minute, just to clarify for people, because we have been talking about bonds a lot on this program, particularly treasury bonds, and for a number of couple quarters, we've talked about the TLT ETF, which I know you have a position in. While the bottom may be in, and you may expect a retracement of sorts in bonds in the relatively near future, just want to make clear for folks, your TLT trade is not closed out, right?
No. Okay, but we do need to make some full disclosure here, because we have two things going on now. So we've been talking about, for our client accounts, right? We own an underweight position in TLT. We're going to add into that at the next, kind of the next opportune point. But you and I talked specifically that, I guess it was 3, 4, 5 weeks ago, that I personally, when everybody was like, bonds suck, I don't want to be honest, I'm going to make a bet. And I bought TLT, and I bought January 24 call options on TLT for January 24, a strike of $120. I sold half of those options yesterday for quite a large gain. And, I'm still holding my other bond position in some of those options. So, so I did sell some of my personal holdings, but our client holdings are still fully intact.
Got it. And your personal holdings, that one was a little bit more of a speculative.
Oh, that was just that had nothing to do with portfolio management. I'm tired of all you people railing about how crappy bonds are. I'm going to prove you wrong. So that's all that trade was.
All right. Well, thanks for sharing that. But more importantly, your thesis that bonds still have a good room to run, particularly if interest rates start coming down because of a pivot at some point. Like, that's still all ahead of us.
Look, the three things that are going to drive bond prices, and again, I'll say this again, I've said it before on the show, bonds will likely outperform stocks by a fairly large margin next year. And the reason is that when you get into a disinflationary environment or a deflationary environment, you get into a recession, you get into economic slowdowns, bond yields are a function of two things. And when those yields will go lower with it. And again, it's a risk-off trade. So when money begins to really worry about the bear market, so to speak, and when that actually starts to take form, money will flow into safety, and that'll be treasury bonds. So no, the real trade in this little bounce we've had in treasury bonds, like I said, is probably mutual fund rebalancing because of the timing of when it's occurring. But the real trade will be next year in the probably second, third quarter, I'd imagine.
Okay. And just so you feel good about yourself, Felix Zuloff agrees with you. And we're going to talk about that in just a second.
Well, he called me before you did the interview, and he asked my opinion. So
yeah, I'm sure he did.
I'm joking. Nobody take that serious. I'm just teasing.
He does watch this channel, so you might get a call from him now that you just said that. All right. So you and I last week talked about some bond sleeves that you and your firm were putting together. That's one of the reasons why I wanted to clarify this, because I didn't want people to think, oh, well, he was really bullish on bonds last week, and then he's telling us that it's going to go down in the near term. You've done nice clarification on that, though. But I've been surprised at the amount of interest that you saw in that. And folks, I'll basically say, I don't want to repeat what we went into last week, but if you want to learn more about this specific bond sleeve that Lance and his team at RIA have put together for folks that are interested in increasing their exposure to bonds, even if you keep most of your money with your existing advisor, but might want to play a little bit in bonds with Lance and his team, just go back and watch last week's video. But for those who are interested, and there is a minimum, I think it was like 100,000 minimum. If you want to learn more about it, just go to wealthion.com/fixed income. You fill out the form there, and the guys at RIA will give you more information. Right before we hopped on here, Lance, I got an email from a viewer who just asked if we'd touch for a moment on corporate bonds, because they were looking at, they didn't mention the companies by name, but they said, big blue chip companies. I'm assuming Apple was probably somewhere in the mix, whatever. And they said, they're beginning to see corporate bond yields of very big blue chip companies that are approaching like 8%. And they were asking, what should we know about the opportunity and the risks here right now in that space?
Well, corporate bonds have a different risk profile to them relative to treasuries. So treasuries will always get paid because the government can print money. Corporations are a function of what the corporation can pay back. So, if you're, and again, there's always the issue of risk analysis. And when you look at a bond and you go, oh, here's this company, I recognize this name. It's a ABC company and it's paying an 8% yield on this bond that's, 5 years, 10 years, 15 years, whatever. So there's several things that go in. And again, Mike Leibowitz was here on the show with you. And I know y'all talked a lot about, did a whole little bond segment, but there's a lot of factors that go into analyzing bonds. So first is you have to analyze the yield, or actually the coupon, right? What's the coupon? What's the yield? The yield is a function of the coupon and the price of the bond. Now, that's all that really matters. The coupon really doesn't matter. So if you look at a bond and a bond has an 8% coupon, that doesn't mean you're going to get paid 8%, right? The yield to maturity is what you're going to get, because you're going to either gain or lose money based on the price of the bond relative to its principal value. But the other things you have to also equate is what is the relative yield? So that what's the yield to maturity of this corporate bond versus a risk-free investment, 10-year treasuries. So if you're getting an 8% yield versus and let's just say 4% coupon or yield on the 10-year treasury, what you have to ask yourself, why am I so lucky to get paid an additional 4%, 100% rate of return on this bond versus a treasury? That's how much risk you're taking on. That's basically a good way to say, I'm getting paid this because there's additional risk in this bond. And just because you may recognize the name of the company doesn't mean it's a money good bond, right? Carvana is a good example right now. Carvana, everybody knows Carvana, right? I mean, they're selling cars left and right, blah, 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 right? That company's on the verge of bankruptcy. And so you can get a bond from Carvana right now yielding north of 20% probably. So doesn't mean it's a good bond just because you recognize the company and you recognize the bond. So you've got to be very careful in buying corporate bonds because you've got to understand your risk of default based on whatever it is. Now, having said all that, yes, there are quite some very interesting corporate bonds. This is why one of the bond sleeves that we're opening up for Wealthion investors is we have our treasury bond sleeves, and we also have a corporate bond and a high yield bond. There is no benefit in buying high yield debt right now because the spread or the difference in yield between buying junk rated bonds and investment grade bonds doesn't justify the risk you have to take to get there. There's not enough of a premium being paid between high yield and corporate. Now, once we get into a recessionary environment, what will happen with corporations and corporate bonds in particular is you're going to buy let's pick what we call, there are certain corporate bonds we call money good, right? We know they're in effect like a treasury. We know the company can pay the debt. Apple's a good example of this. Why? Because Apple has like $150 billion in cash on their balance sheet. So if they have a $5 billion bond coming due, it's left pocket change for them to pay it off, right? So that's what we call a money good bond. Now, there's actually some very interesting Apple bonds, Microsoft bonds, et cetera, that are out there. And certainly you can buy those bonds. Absolutely. I'm not worried about those companies at all. However, when the recession comes, if the market, next year we have a recession, and I'm actually in this weekend's newsletter, which will be published out on Saturday, I'm actually writing out the analysis on pricing out the price target for 2023 using Wall Street earnings estimates and Wall Street's expectations for valuations versus valuations that occur during a recessionary environment. Here's the interesting thing. No matter how you calculate it, because it's just math, the price of the S&P will be lower next year versus where we are now. So there's almost no way to avoid lower prices next year. However, you get into a recession, Apple's going to get sold off. When Apple starts getting sold off, the price of the corporate bonds are going to fall. It doesn't matter that they're money good bonds. So you're going to look at your portfolio and go, why is my Apple bond that I paid 100 cents on the dollar for now worth 93 cents or 92 cents or whatever? Oh my gosh, I'm losing money. That's not going to occur in treasury bonds, but it'll occur in corporate bonds because in a recessionary environment, yields on treasuries will go down, yields on corporates will go up because of the threat of risk increasing for corporations. So you really need to understand if you're going to buy corporate bonds, again, nothing wrong with them, but you need to understand how prices of corporate bonds are going to react in a recessionary environment, the risk that you're taking on, and just realize the more that the yield is on the bond that you're buying, the higher the risk of default is.
That was great, Lance. Thanks. That was a good summation of a very nuanced topic there. And okay, so when you talk about if we do indeed go into recession next year and the markets get nervous and bear market continues and brings stock prices down, we'll see capital run into treasuries, which will push down treasury yields, raising the price of treasuries. But you'll likely see the opposite on the corporate side, right?
Yeah.
So
money will flow out of corporates into treasuries.
Into treasuries, exactly. Okay, so getting back to what I was foreshadowing earlier about what some of our recent guests have said. So I always like it when smart people who have different methodologies still come to the same conclusion. And I interviewed Mike Green from Simplify, Axel Merck, who runs his own funds, but is also a big Fed watcher, and then, of course, Felix Zulauf this week. And all of them were pretty critical of current Fed policy, thinking that the Fed is hiking overly aggressively right now and ensuring a deeper recession than we should have otherwise, right? And in Mike's language, it's going to be, quote, almost impossible to avoid a recession. In Axel's case, it's going to be a deep and grinding recession. Felix's case, a little bit different. He thinks it's going to be a shallow recession, but only because he believes, like you, that the Fed is breaking something here, and that the Fed is going to be forced to pivot, that Powell's not going to be able to enjoy his, I'm going to pause and hang out for multiple quarters, right?
Yeah,
Felix does not believe that's the case. And, everybody's looking through an imperfect lens at the future, but Felix kind of pegs it like around end of Q1. That's when he thinks something's going to break. So pretty much all these guys expect asset prices to now fall again, going more or less from end of this year through Q1. Then maybe they diverge a little bit, right? Maybe we're stuck in a prolonged recession, and maybe it's just a sad bear market. In Felix's case, it's a pivot. It's a pivot that's probably a really big one. He's not necessarily saying that all asset prices are going to immediately turn around, but certainly some will on the news. And bonds are one of the ones that he says, will, and you've said that a lot yourself. So he expects a very strong 6 to 9 month performance for bonds once a pivot is announced. He expects a couple other things, but first, let me get your reaction to that. I see you nodding as I was saying all that.
Yeah, no, I think, look, and this is part and parcel of the article for the newsletter I'm writing this weekend at realinvestmentadvice.com, which is, I'm laying out this premise for saying, look, here's the data. Here's what Wall Street expects in terms of valuations at the end of next year. Here's what recessions say valuations should be at the end of next year. So I'll lay out all this data, right? I come up with two conclusions of different price points for the end of next year. Both of them are lower where we are now. One is about 12% lower. One is 26%, 22% lower. So that's just math, right? It doesn't mean that's how it's going to work out, but that's the math. But in the article, I just say, look, is there a possibility we could have no recession? What bothers me about all this is that everybody agrees there's a recession. And we talked about the risk of, being a contrarian. When everybody agrees about something else tends to happen. So, how could we avoid a recession? Well, we could avoid a recession if employment stays really strong, right? We don't have, accelerating layoffs or unemployment. Consumers are able to continue tapping credit cards to continue spending, right? Consumption is 70% of the economy. So as long as they're spending, economic growth can continue. Wages, go up to offset inflation, and, consumers are able to spend, right? Keeping that going. So if they don't lose their job and they keep spending, then, theoretically we could avoid a recession. But the problem with that, and I don't know why you're laughing, because I know, but that's the premise, right? That's how you avoid a recession. The problem with that is that if you have stronger economic growth because consumers are spending more and wages are going up and employment is strong, guess what you have? You have inflation, which means the Fed's going to keep hiking rates, right? So it's the end game of this is ultimately the Fed and the reason I'm telling you this is the Fed has to break something. Like there's no way to stop what's going on right now without breaking something, because the only way you're going to bring inflation down and get unemployment up is you've got to basically cripple the economy at some point. And so I agree with Felix. I don't think there's any way around that. I think that probably end of first quarter, second quarter, I think he's right that that's where all these past rate hikes that we did this year, those 75 basis point hikes, they collide with the economy. You have a very sharp buckling somewhere. Look, we're seeing fractions of financial instability all over the market right now, right? So we talked about FTX. Then you have Blackstone gating their funds. You're just starting, and the problem with the Blackstone's not Lehman, right? They're $800 billion. They're a big giant firm, but mostly what they manage is funds for other people. So they're not the problem, but they are a microcosm of the risk in the rest of the market with all these private equity funds, all of these private REITs. And this is why I tell people all the time, the worst, we have clients come to us all the time. It's like, oh, I've got this money invested in, this private investment over here that does viaticals or whatever. Or I've got private real estate investments and I have private equity that's just been kicking ass for the last few years. I don't want to sell it. Well, in bull markets, all that private stuff works. In bear markets, it doesn't work and you can't get your money out. And this is the problem with private investments at all is lack of liquidity. So when you go to show up, I'm not liking the way this is working out. I'm a little worried about commercial real estate. I'd like to get my money out of that fund. They go, well, you can't. So, you're kind of stuck.
And also when you can, you may find that the price is very different than what you expected, right? There's another issue with these private ones. It's lack of transparency because they're not really marked to market in a lot of cases, right?
Yeah. And a lot of them go to zero. I mean, people invest in viaticals, that stuff goes to zero all the time, right? I mean, it's just, you've got to really understand when somebody's pitching you a deal. And look, this is what happens during liquidity-driven bull markets. In 2020 and 2021, right, we had $5 trillion of liquidity, $120 billion a month in QE. Too much money chasing too few assets. Blackstone's AUM, that's their assets under management, doubled in 1 year. Went from, just a massive increase in just money flowing in these investments. Well, when money flows like that into investments, they've got to deploy that capital. And so when you've got to deploy a massive amount of capital into a limited space of assets, that means you're going to wind up with a lot of less than quality assets because you're just trying to get money placed. And this is the problem with SPACs and IPOs being rushed to markets, is that's money trying to chase assets, and there's just too few quality assets. So we wind up with all this crap that gets in the market that we've now got to flush through, and investors lose a lot of money. This is why I just beg people all the time, like, don't do that. Stay, we always talk about liquidity as your primary theme of your portfolio. So, as we said before, you only have three ingredients of any investment. You have liquidity, safety, or return. You can only have two of those three at any time on any investment. So if you want return and you want, safety as an example, you have to give up liquidity. And the problem with not having liquidity is that possibly when you want to get your money out, you can't. And that becomes a real problem. Because that always happens at the worst possible time, right? As long as things are great, you can always get your money back. It's not when you want to get out, that's when you can't get your money back.
Yeah,
so anyway,
exactly.
But the reason I bring all that up, and I apologize, but this all goes back to financial instability. We're seeing those cracks in financial stability. And I think Felix is right, is that next year, I don't know whether it's another FTX type event on a much larger scale, or if it's, a bunch of private equities folding up, if it's a surge in bankruptcies, don't know what it's going to be, but I think we're going to see something that causes a real pivot by the Fed. And as we've said before, and we talked about our article, my article last week, which is, when the Fed pivots, you're not going to want to buy stocks then, because that means something's broken and they're having to try to bail it out. And that's not the time to own equities.
Okay. All right. Well, good warning. And I just have to put it up here because you mentioned the danger of some of these private investments, how bad they can go sour. You mentioned SPACs. For folks that don't understand what a SPAC is, I'm going to let Lance describe it simply because my voice isn't going to hold out long enough. But I want to put up a chart here of one SPAC that went public back in not all that long ago, just a couple of weeks ago. This is from Wolf Richter's website. The company is Grindr. It's a social media app for the LGBTQ community.
Yeah.
And you can see here, this thing went the day after the SPAC merger, it hit an intraday high above $70 a share, and then immediately plummeted. I mean, the next like 2 days back down to 10%. It's something like $8 right now. I mean, it's just the ability of these things when they go bad to just completely vaporize investor capital is stunning.
Yeah. Look, I mean, there's so many bad puns you could make about this.
You could, I know.
So I just keep thinking of banana in the tailpipe with Eddie Murphy. Anyway, the issue is that again, during the okay. So first of all, let's step back. What's a SPAC, right? So a special purpose acquisition company. That's what this is. Let me give you an example of how this works. There are a lot of shell companies that are out there. These are companies that have been formed. They are registered. They are publicly traded. Now they trade for a penny or two on the pink sheets, right? But they're just an empty company. They're a shell that's been set up for public trading. And so what I can do is if I want to go public, I can take this empty shell that has nothing in it. And then let's say Adam and I, we have a social media company that we want to take public, and our social media company doesn't do anything really. It has no revenues or no business plan, but hey, we want to go public because we just want to get some money from people. So we merge that company into the SPAC. So now all of a sudden, this company with no business plan, no real revenue, no real growth profitability structure to it is now a publicly traded company. So now what I can do is capitalize on market premium of people coming in and buying the shares and driving the share price up. So what can happen is Adam and I can sell our shares and take our profit out of the company, and you're kind of left holding the bag. And so this is what happened with a lot of these mergers. You remember Aaron Rodriguez was going to come out with a SPAC, and we had everybody, a whole variety of SPACs coming out trying to find companies to merge. They were just issuing SPACs and raising capital, and they raised $500 million in capital going, okay, give us your money and we'll try to go find something to buy.
Right. And then we'll figure out what to do with it. There's a public offering for something that didn't exist. They didn't even know what it was going to be yet. Yeah.
Exactly.
Let me just interject so then you can finish. But this could have been the rant for the week, but like this is an end run around the whole registration process and filing process, right? So it's basically, it says, look, I mean, it's almost kind of like if you lose your money in these things, you've got nobody but yourself to blame. But this company has basically said there's a process to go through to go public that demands that I have to be transparent and I have to come up with a company that has value and I've got to earn my way there, or I can just kind of cheat like this.
Yeah, no, that's what I was going to say. But that's great. I mean, here's a simple example of this. Adam and I have a company. We have no idea what we're going to do. We don't have any product that we in mind yet, but we want to form a company. So if all of you people watching this show right now would just send us $10, we'll take your money and we'll go start a company. Who would do that, right? Who in their right? I guess there's people that would do this because they did it, but it's like these GoFundMe campaigns. But people, when you make an investment in something, understand what you're investing in and make sure there's a value of what you're buying. Just don't buy stuff because somebody told you to do it.
Yeah, well, and there's nothing preventing, once that money comes into the company, there's nothing preventing the current shareholders from selling out and just slipping out the back door, right?
Yeah.
So anyways, I don't want to get too distracted on that.
I know. But that's a whole rant, but yeah.
So back to Felix for a moment. So he talked about how He expects bonds to do quite well once the pivot's announced. He expects markets to do very well. He expects basically a bull run, assuming this happens in Q2 of next year, as best he can forecast, kind of a bull run through 2024, where it'd be a big one. When he said basically like the major indices would probably like double, right? That type of, so if, let's say we fall down to 3,000 in Q1 and then we pivot, that would be a 6,000 or so on the S&P, right? He thinks commodities will fare even better. And that's more for, both rising with the stimulus, but also just more structural reasons. He thinks that the world order really has changed from a global trade standpoint. It's become a more bifurcated world. It will never be as globalized as it was before. It's going to be more deglobalized going forward. So he thinks there's going to be a higher floor under commodities going forward, which of course means persisting cost push inflation from that, not even taking into account all the demand pull inflation that's going to be put in by all the stimulus of a pivot. Yes, not every asset's going to do an immediate turnaround upon the announce of the pivot, but he does basically see everything eventually turning around in the later half of 2023 from all the stimulus. And then we have this sort of last great rally for one more year.
I don't. So I've got an article out on realinvestmentadvice.com today, Friday, talking about, it's part one of a two-part article saying, will a weaker dollar be good for stocks? And so I went through the analysis of the dollar rally we had this year, and this goes back to 2021. I was having a big fight with Michael Brush over at MarketWatch, saying the dollar was going to get substantially weaker, which is what happened in 2021. That set up this very big rally in the dollar we had this year. So now talking about the correlation between the dollar rally and stocks, in which we saw a lot this year. And I'm going to get to your question here. This is part of it, though.
Sure.
We had a very big correlation this year. Strong dollar meant stocks went up, right? Historically, there's no correlation between the dollar and stocks. It's all over the place. It's a very, very low correlation. You can have years where you have a positive correlation, years where you have a negative correlation. Some years you have both, right? It happens. So the dollar really doesn't have a very high correlation to stock movement, but it has an impact on corporate revenues, earnings, and economic activity. So what the dollar is doing is important. So the premise of part one of this article is talking about the dollar rally, but then we move into part two on Monday, which will be out on Tuesday. And to Felix's point, our premise is that bonds will do well in the first half of the year, stocks will do well in the second half. And that's because of exactly what he's talking about, as well as that in the first half, bonds will do well because we're going to get all these rate hikes catching up with the economy. That's going to cause the dollar to decline because you're getting into a recession. Weaker economic growth will lead to a weaker dollar. That's going to have its own set of consequences. But that weaker dollar will translate into a corporate revenue boost from multinational companies in the latter half of the year. So after the Fed pivots, you're now going to have this strong, kind of the strong tailwind of the dollar behind stocks, lower interest rates, lower inflation. So, you kind of get the right mix of ingredients for a fairly strong stock market rally. Now, I'm not saying it's going to double. That's 3 years out. I can't predict that far out. So, but I do suspect once yields approach 0 to 0.5% on the 10-year Treasury, that you'll want to sell all your bonds and buy mostly big blue chip dividend yielding companies.
Yeah. And man, I mean, if we're at a point where yields on the 10-year are getting close to 0, at some point next year, folks that are in them right now are going to make a fair amount of money in those instruments. Yeah.
And that's not outrageous, by the way. We were at 0.5% of the 10-year Treasury in March of 2020. So we're just going to retest lows. That's all that's going to happen.
Yeah. Okay. All right. So I want to get into housing and jobs, just to sort of keeping our pulse on those markets for folks. Real quick, there was a stat. I'm going to put a chart up here, but it's showing that one of the things we've talked about is the pig through the python. of
Yeah.
all the stimulus that was pushed out, right, in the wake of the pandemic.
Yeah, I have an article on that coming up too.
Okay, good. Mr. I have an article on everything. One of these days, I'm going to pick a topic you haven't written an article about yet.
I doubt it.
But we've sort of asked ourselves, people have asked a lot, well, how much of the pig really is left in the python? And this is one of the few charts I've seen that tries to quantify that. And it shows that there still is excess cash in consumer banking accounts. And you've talked about this, Lance, and you've warned people to not interpret it too literally, that it's very skewed. Most of it's in the hands of a few people who have a lot of money, and a lot of other accounts are already actually out of money already. But it's predicting, the trajectory shows that the excess cash pile is going to be gone by mid 2023.
Yep.
And I think it shows there's still about $1.5 trillion in there to date still. So, a lot of people are looking at things like the skyrocketing amount of consumer credit, or a lot of the signs of hardship that we're seeing with a lot of workers, and saying, hey, how come that isn't translating yet into like a total drop off in consumer spending yet? I think part of it is while we are seeing some weakening in consumer spending, it still is subsidized by this pig that's passing its way through the python. But we now kind of have a timeline here that says that pretty much will all be gone in the next 6 months.
Yeah, that's absolutely right. I mean, if you take a look at, I've actually written an article talking about the fiscal pig in the economic python. And that's the title of the article that'll be coming out. But in there, I've got a chart of personal consumption expenditures versus credit cards. And you can see, so credit card debt, it kind of rises slowly over time, and people just keep taking on more and more and more debt to subsidize their spending. And personal consumption expenditures and savings, kind of just roll along, about that same rate. But then all of a sudden you get to 2020, it's this huge spike. And it's very clear. I mean, you can see literally the pig in the python, right? I mean, it's just so clear of this big giant savings spike. But now that's all, to your point, that's all declining. And importantly, and again, as we talked about before, the bottom 80%, they don't have any savings, right? That's why credit card debt's going up. Here, when you hear these stats from people, they go, oh, the consumer's fine, right? They've got plenty of excess savings, and their savings rate relative to disposable personal income is fine. There's no trouble with it at all. That's all skewed by those top 10% of income earners that are sitting on a tremendous amount of cash because they have nowhere to invest it right now, and they've got no debt to speak of. Everybody else, if everybody else was like that, why would credit card usage be going up? I just spend my cash in savings, right? Why would I spend more money on a credit card? That makes no sense whatsoever. So you just have to you think logically about these things economically, and just understand that a few people, when they have massive amounts of wealth, can distort and skew statistics across the whole median. And we don't have it's like all of our economic data, we have samples of stuff. And so we can make assumptions based on samples. We don't have really good data of every American in the economy. But what we do know is by talking to our neighbors and friends and families and others, is that most people are not happy. And the dinner table conversation is, Jesus Christ, I can't afford to go eat. I mean, go to Chipotle. I saw your post, I think it was last week, about Whole Foods, right? Versus Chipotle's like $50. And that's true, by the way. You want to go have dinner at Chipotle, it's $50. And, it's just expensive everywhere. And that's impeding people from spending money elsewhere in the economy. Yeah.
And, that Twitter discussion was between me and Lynn Alden, where she talked about the expense of going out to eat at Chipotle. And, I revealed to her that food price inflation's gotten so bad in my town that the cheapest place for me to go just get food from a local eatery, if I just want to go grab something, is Whole Foods. It's the Whole Foods hot bar. They cook in bulk and they sell by weight. And it's crazy to me that Whole Foods, which many people rightly refer to as Whole Paycheck, has become the cheapest place in town for this. But that's just a sign of how fast food service prices have really increased here. And along with that is, I'm very sensitive to the fact that for a lot of these, smaller restaurants, they're doing everything they can just to stay in business right now because their input costs are going up. But I think a lot of this is really driven by wage costs, and that's something that's not going to come down anytime soon for them. And so, kind of my main conclusion with Lynn was that the return on investment, or the ROI of dining out, has now gone negative. And more people are going to be like me. They're just going to say, look, I'm not going to go to a restaurant. I'm not going to go to the sandwich shop. I'm either just going to go to the Whole Foods hot bar, or I'm just going to buy the stuff in bulk and I'm going to make it myself at home. And yeah, I'd much rather have the convenience of going and being able to get a sandwich somewhere, or, taking my wife out for a nice little dinner, or my kids out. But it's just gotten so pricey that it's not worth it to me anymore. So yeah. I do think that, especially as we head into a recession where people are going to be constraining their spending anyways, they're going to be shifting their spending in this way that I think is really going to decimate a lot of small businesses. And it's very sad.
Yeah, it is. And, this is that kind of part and parcel of this whole problem that's going to feed through to the consumer. And again, to the point we said earlier, it hasn't shown up in the economy yet, but it's coming. And I think it's just a matter of time until, you start to see people really have to just make that decision between eating at home and eating out, and other purchase decisions within the economy.
All right, well, let's get into that here, because you and I have been banging the drum for a long time that on a probability standpoint, it looks like tougher times are ahead for the economy next year. I just mentioned a bunch of smart guys, Felix and Alex and Mike and a bunch of the folks I talked to who agree with us on this. And we're now beginning to see an increasing amount of the data that's showing this is happening. So let's trundle off into the housing market for a minute. I'm going to pull up a couple of charts here, Lance, and then I'll let you go. So here's a chart showing mortgage payments for a median new home as a percent of median new income. And you'll see here that this ratio has exploded up from a 20-year, near 20-year low of 24.5% just a little while ago. It's now up to 49.4%. I mean, this thing is hockey sticking, as we talked about, I think, last week or the week before. I know you think the worst time to buy a house was back when, prices were at their absolute zenith, but it's the worst time to buy right now, because you still have prices that are very elevated and you have mortgage rates that are super high, right? So we're just beginning to see that home price affordability was bad to begin with, but it's just gone insane recently. Right now, because of that, we're having this massive, Mexican standoff between buyers and sellers right now, right? And that's totally proven here in the numbers. Transactions are drying up. U.S. pending home sales, the U.S. pending home sales index is now back to the lows we saw in 2020 when we literally shut the country down, right? We're now back in that territory in terms of transaction volume. How bad is this buyer strike? It's pretty bad. This chart shows home buyer traffic has plummeted this year from recent highs up in the 70s. It's now down to 20, which is where we were kind of in the 2008 through 2010 trough of the housing bust, right? So, all of this stuff is, exactly what you would expect to precede home price declines of serious nature. And I think that's where we are in the story right now. The transaction volume has dried up and affordability has gone through the roof. And we're down that point of the cliff where Wile E. Coyote is in midair looking down and gravity is just about to kick in.
Yeah, I really, it's pretty fascinating to me, here in Houston, even, just houses come on the market and, prices come down a little bit, and then somebody buys the house. And, so there's still you don't want to mistake this as being, there's no transactions going on, because there are transactions occurring. It's just,
I know two people who just sold and bought houses the past week.
Yeah. And you go, okay, so it is interesting. But it is interesting because, you look at traffic, you look at volume of purchases and sales. There was a very interesting, I was eating lunch the other day and the TV was running in the background, and that showed Dr. Phil. He was on, and there was a realtor on the show complaining that because of her race, that nobody would buy houses from her. And I was like, hold on a second. There's nobody buying houses from anybody right now. So, you got mortgage rates went from 3% to 7.5%. It says nothing to do with race, ethnicity, religion, you name it. It's because mortgage rates have doubled and people can't afford a house. But hey, we gotta make causes, right? But anyway, the interesting thing here though is there are still transactions going on. And to your point about this kind of Mexican standoff, I'm waiting, and maybe it won't happen this time. I don't know. There's a lot of arguments about a shortage of supply of houses. I'm not sure that's really the case. There's always plenty of houses available. It just depends on what price somebody wants to sell something. And maybe we just haven't lost enough value in homes yet to start dinging into those people that, all their equities in their house and they're starting to see it evaporate, right?
Right.
And we haven't forced them into the market yet. So it's probably still coming. But when that occurs, I don't know when it's going to happen, but maybe later next year, we see a much bigger drawdown in house prices. I hope so, because I'm looking to buy one. So
I know. Yeah, no, I think we will. And I keep wanting to bring up these charts. And by the way, these recent charts here are from Nick Gurley, who is the housing analyst I've had on this program in the past. I was just texting with Nick, trying to get him on the program before the end of the year. And he says he's got an awful lot of additional data beyond what I'm just sharing here with you folks to bring to that conversation. So very excited to make that happen when it works in the schedule. So just a couple more charts here. So, not only are guys like you and I, noticing this, but the word is out, right? And the Restoration Hardware CEO, here's a quote he just made. He said, there's one thing I'm certain of. The housing market is collapsing at a level I haven't seen since 2008. I haven't seen this kind of drop since 2008. So, a guy who basically his company makes their, revenues off of home sales and home furnishings. He's basically saying the housing market is, quote, collapsing here. And he's comparing it to the magnitude that we saw back then. I'm going to put up two charts here real quickly, Lance. You and I have talked about one of the things that's different about the market this time around is the high percentage of institutional investor capital in the residential real estate market. Investor purchases of residential housing is plummeting right now. And we saw actually, there were many fewer investors back then, but we saw investor purchases plummet back about a year before the housing bust went through last time, right? So this is sort of a leading indicator, and we're now seeing the same canary die in the coal mine, with the institutional, the investors, housing investors this time that we saw last time. And related to that is this chart where I think you and I have talked about it briefly, Lance, but it's really interesting. It's now more profitable to buy a 6-month US Treasury bond than it is to invest in real estate at current cap rates.
Yeah.
Right. And, I'm sure some real estate investors will, challenge this and say, hey, it's not apples to apples comparison and whatnot. But one thing that's very different between the two options is you've got no risk with a 6-month Treasury.
Yeah.
When you're a landlord,
you also have liquidity too.
And you've got liquidity. Yeah, you've got this illiquid asset that you've got to deal with people that may or may not be good tenants, right? They might wreck the place. They might leave in the middle of the night. You've got to worry about termites and plumbing. And just all that stuff, all that headache that goes along with being a landlord. And right now, if you look at average cap rates, it's just, why wouldn't I just put this in a short-term Treasury?
Yeah. It's interesting. I have a very good friend of mine who is he owned one of the largest mid-tier mortgage companies in the country, started it from scratch, built it up, sold it. Extremely knowledgeable about real estate investing and all this type of stuff. And I used to have him on my show quite often just to talk about, kind of like Nick, to talk about the real estate market. And, he has a rule of thumb. He says, if I can't make 12% on a piece of real estate, I don't do it. He says, because what people don't realize is that, great, I'm going to buy this house. I get a 7% yield on this house. Well, first of all, you can get that yield in a lot of places without having this illiquid asset. But also the other side of this is that once you start to factor in plumbing the toilet at 2:00 in the morning, replacing, stuff that people tear or steal or rip out or whatever, and you start factoring in all the time that it takes to manage that property, at 7%, you're losing money. You may think you're making money, but you're really not once you start factoring in all these other factors that go along with managing real estate. And then if you slap on a management, it's like, I don't do that. I have a management company. Well, you got to pay them. So that even further reduces your total returns. He says, so, when you're looking at your return rates and those type of things, if you're not making 10, 11, 12, you shouldn't even think about doing it. But this is a guy that has made a fortune literally in managing real estate, so he knows what he's talking about. But it makes perfect sense, because if I can make 6, 7, 8% a year on just buying and selling stocks, why do that with a piece of real estate?
Right. So, just to bring this back around, why this is important is because housing is priced at the margin, which means that the guy who shows up with the most willingness to pay gets the house. And in a lot of places, that's been these institutional or these investor buyers, right? They show up with all cash, or they're just willing to pay more. They are now getting out, right? That's what this data shows, right? And then, of course, you and I have talked about the potential risk, which is things get really bad. Then you've got some of these investors that own a bunch of different properties in a certain area, and they might just need to start dumping them, to start dealing with their own particular situation, which could make the market crater even faster in a market. So not necessarily saying that exactly is going to happen yet, but we are seeing the signposts on the way to that type of possibility. Yeah. All right. So that's housing market. I'm going to put up a couple of jobs charts too. So, we had a bunch of jobs reports out the other week. I think you and I talked about them a little bit there, Lance. They're still telling a story of a strong, market from an unemployment standpoint. You and I have parsed ad nauseum, the suspicions that we have and the big jobs gap between the establishment and the household payroll surveys. But I'm going to put up a chart real quick here. Despite sort of what you're saying earlier, despite the rosy tale we're being told about how robust the jobs market still is, we still are hearing companies announce hiring freezes. We're still seeing layoffs go through the roof. This chart here shows that layoffs really ramped up in November. This is a chart of tech layoffs, but it's a pretty generous definition of what tech is. It is beginning to become personal. I know I just actually met with a guy last night, a friend of mine, who just got laid off by his technology company, right? So it's beginning to become real. These are not just random headlines that we're reading now, beginning to heal real people that are, beginning to become victim of this layoff wave. I think the Fed is still continuing to lead into the rosy data as a way to, just like you said, it's going to go to the market when it can talk again and start using tough love again. I think it wants rationale to be able to continue tightening, right? And so I think it's sort of turning a blind eye to the destruction it's beginning to create, because in some ways it's what it wants to do, right? It wants to bring demand down. That's, as he said, we're going to have to take some pain. Part of that pain is companies are going to have to downsize. Some companies are going to go out of business and whatnot. I think this is all part of his plan. So, I think we need to expect that the momentum from this is going to continue to build into next year. I've got a few more charts, but I'll let you respond first.
No, I think that's absolutely right. We've seen the kind of early phases of companies just downsizing from kind of overstaffing during the pandemic shutdown. But now I think we start getting into core jobs as we move into, the next year, particularly if we start getting much deeper, slow down in earnings, slow down in profitability. First thing corporations do is start laying off workers to protect those margins. And that's really all this comes down to. Okay.
Yeah. So, all right. And also too, for folks that are worrying that I'm going to forget to ask you about your trades, I'm not. I'm getting there right after we finish jobs. But I'm going to put up a quick chart here just to show that when we look at initial and continuing jobless claims here, the argument's now over. We can now see that these are both rising again, right? So, people are beginning to get pushed out of the workforce by the trends that we're talking about here. It's no longer academic. It's really, really true. And so now I want to flag, we've touched on this in previous videos, Lance, and maybe we want to talk about it next week after we have an interview that I'm going to have this coming week, which is we've talked about how when we talk about the unemployment rate, it's a very deceiving number because the calculation for unemployment does not include the people that the government has determined are not in the labor force, or that they're sort of, it's given up on. These people are unemployable, right? And that number is over 100 million adults, right? So there's almost a
you have to quantify that though. You can't just say 100 million adults. That's a third of the U.S. economy.
Just about to say, yeah,
yeah.
It's about a third of the country, at least a third of the adults in the country that we're just ignoring. Right now, yes, some of those people are too old to work. Some of those people are still in their later teens and they're still in school where they should be. Some of them are in the military. But when you parse it all through, there's a concerning just massive amount of people that aren't in the workforce who otherwise should be, or at least we would benefit economically if they were. And secondly, there is a really dangerous trend of working age US adults opting out of working. And particularly it's a problem with men ages 25 to 54. And I circulated an article on Twitter yesterday where Mike Rowe was really waving the warning sign about this. And most folks know Mike Rowe from the whole dirty jobs, and he's been a really good advocate for the benefits of work in society. But he was citing the research of a guy named Nicholas Eberhardt, who I reached out to, and I'm actually going to be interviewing early next week, which is why I want to flag this, Lance. And he says there's 7 million American males between 25 and 54 who literally are just checking out. They're just saying, you know what, this just isn't working for me anymore. I'm not making enough to interest me. The ROI of my time and energy just isn't good enough for me, and I'm just going to check out. I'm going to play video games on the couch or do whatever. Yeah. And there's enough of that money sort of still sloshing around, maybe enough of that excess money we talked about, where they're still able to largely get income from parents or girlfriends or spouses or whatnot. And look, on an individual level, it's everybody's calculus, what's right for them. But on a societal level, when you have that many of your, prime age, most productive bodies, in your body, in your society, that just tune out. That is not good at all from a societal standpoint.
Yeah, no, in my article that I'm writing about the pig and the python is talking about, part of that article is demographics. And, if you take a look, and this is the kind of the fallacy of a lot of these statements, is that people say, well, there's, out of those 100 million people, right, there's a whole bunch of those over the age of 65, they're all retiring. No, they're not. They can't afford to retire. They don't have enough money in the bank to retire. They can't live.
Sorry to interrupt, but latest stat, I just pulled it right before this. 49% of US adults age 55 have zero in retirement savings. That's right. So just about half.
Yeah. And so they can't not work. They may be working part-time. They may be working 3 or 4 part-time jobs to make ends meet, but they're still working. They're still out there. And, yes, we have people under the age of 16 that are obviously living at home with parents and not working. But that's, when you start talking about, there's 400,000 people in the military. So 100 million people, strip out 400,000 people in the military. That's a rounding error. There's a lot of individuals, to your point, that have just checked out. And look, there's enough free money in the system. When you talk about social transfers, from this, and we talked about using, we've had a big surge in disability claims, right? Easy to claim disability and to get money coming from that. I take out a student loan. I don't necessarily go to college, but I take out a student loan and I've got money to spend. So there's enough free money in the system that people don't have to work if you start learning how to game the system and how to tap into, different types of payments and so forth and so on. That's, and we're seeing a lot more of that. And if you watch TikTok or some of these other social media channels, you'll see a lot of young people on there between 25 and 30 years old, and they're complaining about how capitalism sucks and we need to all be socialist now because it's not fair that all these rich people have all the money and they can't get a job and they don't get paid enough for their time, and then all these type of things. And just when you start talking to them, it's like, okay, well, what was your degree in college? Well, my degree's in sociology, right? Nobody wants to hire a sociology degree and pay for that, right? I mean, what we need is computer engineers. We need computer scientists. We need engineers. Those are the things that are making the world go. Artificial intelligence. So but we have, if we're going to participate in the economy, we have to do our part, right? You can't just show up at an employer's door and say, hey, I'm here, give me a job. you have to have a skill set that they're willing to pay for. And if you want more than minimum wage, have a skill set that is valued at more than minimum wage. That's just the way the economy works. And look, and we've raised an entire generation of kids saying, oh, go to college and you're going to get a degree and you'll magically get this job of $100,000, $150,000 a year with a corner office. That doesn't happen. And don't forget about trade skills. If you're sitting here going with my psychology degree or your psychology degree, whatever, trade schools are there. Learn to weld, learn to plumb, learn to be an electrician. Those are six-figure jobs. And guess what? Those have a lot of job security because people always need stuff fixed. And, it's not glamorous. It's not sitting in a corner office, but it'll certainly support a decent lifestyle.
Yeah. All right. Well, we'll pick this thread up after I've got the insights from the interview. But, to your point, like demographically, we are an aging populace, right? And so, and it is unfair, right? When Social Security was introduced, I can't remember the exact stats off the top of my head, but there was something like, 7 or 8 workers per retiree. I think it's now down to like 2 or 1.5. I mean, it's really cut like that, right? And so that already is a disproportionate amount of weight on the shoulders of those who are working age. And then if you have more of those folks of working age checking out and saying, nope, I'm not doing it, right? You're eroding the base of the whole pillar, even more so. So big issues that we're facing there. All right. So we'll get to your trades and then we'll end on, we'll do a mini rant, although given the topic, I don't know, I'll see how much you can control yourself, but what trades, if any, did you guys do this week?
None this week. We trimmed last week. It was interesting. Last Monday, actually, we sold the remainder of energy stocks because of the big gap that's shown up between the price of energy companies and the price of oil. And there was interesting that there was a Bloomberg article out today talking about that gap and saying that oil stocks will likely catch down with oil prices sooner than later. And we were like, hey, welcome to the club, but we're kind of at target exposure right now for the end of the year. We're running about 35% equities. The rest is in cash, short-term fixed income, et cetera. So didn't really need to do much this week. We are kind of eyeing a couple of opportunities. We really like Costco long-term. It's been beaten up here lately on a little bit weaker sales outlook, but it's kind of coming down into a good place where we might look to maybe add some of that and add to our current position in our portfolio. But right now we're just being a lot more cautious. Again, want to get through the Fed next week, see what they say. Do think they're going to be more hawkish, and then we'll see what we have to do to set up for the end of the year. We might do some trading if it looks like we're going to muster a Santa Claus rally.
Okay, and I'm sorry, how much of your oil company exposure did you? What percentage wise did you cut there? And the reason why I ask is I just want to give folks the full context. Price of oil, it rose at the beginning of the year in response to the Russian invasion of Ukraine. It got up to about $120 a barrel. It's now down very close to $70 a barrel. I mean, that's a 40+% decrease over the past couple of months. So energy stocks obviously zoomed higher when oil was going higher. The price of oil has really come down an awful lot. The stocks haven't and may catch up, right? That's the whole thing.
That's the whole view. We've traded energy stocks a good bit this year. We bought them basically in November of 21 before they took off. Built an overweight position in our portfolio relative to the index. Have sold those multiple times along the way up. We bought them on dips, sold them again on rallies, and now because of that gap between oil prices and energy stock prices, those oil prices will feed through to their earnings, right? So there's there's a high correlation between oil prices and energy stocks historically. So when there's a big deviation between those two, eventually somebody's got to catch up with somebody. Either you're going to get a big run in oil prices or you're going to get a drop in energy stocks. And considering if we are right about a recession call for next year, that means lower oil prices, lower energy stocks. So we went ahead and took the rest of our profits. We made a lot of money in them this year, and we'll look to redeploy that at a better price level.
Okay. And again, just so folks understand the size of the move, it sounds like you took the rest of your profits. Like
we have no energy exposure.
Okay, great. That's what I wanted to clarify. All right, great. Well, look, as we wrap up here, there was a headline that caught my eye and I said, God, I got to talk about this with Lance. It was an article I think I saw on CNBC about a recent survey of millionaires. And it showed that 35% of millionaires says that it's going to, quote, take a miracle to be able to afford retirement.
Yep.
And, when you and I were kids, Lance, if you had $1 million, you were a millionaire and you were set for life, right? The purchasing power has eroded so much at this stage in the game that not only you're not set for life, but I mean that 35% of everybody who's got over $1 million net worth. So this is,
Yeah.
multimillionaires
Look,
are worried about retirement.
Yeah. Well, look, don't forget, I've written articles about this. This is a whole stupidity of like these financial independence, retire early articles and stuff like this. It's like, oh, if, just do this, just save this much, get to $1 million and you can retire early. Right. And back in 1980, if I had $1 million, I could make 12% of my money by buying treasuries. Right. So it's $120,000 a year. And I can live on that because the cost of living, the living standard back in 1980 was about $12,000 a year, right? For the average household of 4 people, right? Today, that average cost of maintaining a living standard is north of almost $60,000, right? So you have to adjust that living standard for the cost of inflation and everything else. So now you can't buy the same things today that you could buy with $1 million back in 1980. You have to inflation adjust that $1 million for both inflation as well as the level of interest rates that will pay you that income, right? So 10-year treasury right now, let's just say it's 4%. So $1 million gets me 40 grand a year. If my living costs are $65,000 a year, I'm $25,000 short, right? So it doesn't, the math doesn't work. And the whole problem with all these articles is nobody does that. I've run the math. I've written articles about this on our website at realinvestmentadvice.com. You need $5 million, and that's based on 4% withdrawal rate. But if yields fall back towards 0.5% or 1% where we were before, now that number is north of 9 million. Because of just what you can generate in terms of income. So, right. But again, nobody ever adjusts for these cost of living adjustments over time.
They don't, and just to make sure that not everybody watching is going to stick their head in the oven if they don't have $9 million right now. We're basically running the numbers for being able to retire and to not have to really downshift your lifestyle at all for the rest of your life.
Right. Yeah, no, look, we run financial plans so every client that comes into our shop, we run a financial plan for them. And look, you have to remember one thing about retirement. When you talk about stuff like this, you're talking about just this kind of overarching idea, this theme. But look, I've got clients that can retire on $500,000, right? They have very minimalistic lifestyles. They're very frugal. They own their house. They don't have any debt to speak of. And so $500,000, they'll live the rest of their life just fine. Between that, Social Security, their pension, whatever, they're great. I've got other clients who can't retire on 10 million because their lifestyle
is too high.
Yeah. And so it's all a function about really what your lifestyle is, what your expectations are in retirement, and whether or not you can retire based on some reasonable rate of return. So that's why financial planning is so important, because using these kind of just general metrics really obfuscates the differentials between where you live, how you live, what your lifestyle looks like, all those different variables that affect you personally. What other income do you have? Do you have a pension or not? Do you have Social Security or not? Do you have a wife with a pension or not? All those things matter and they make a difference.
They do, and I'm glad you reminded me of the excellent webinar that your team did for us a few months back on retirement planning, because there are all these other levers that can be pulled. So, folks, if we've got your attention about retirement and you haven't watched that retirement planning seminar, would like to, just go to wealthion.com/retirement planning. That was a phenomenal free webinar that your team offered there on that topic. So I think we have to be really cognizant of the fact that, if we want to retire well, A, we really have to plan for it, and B, we may have to redefine what well is and not just be thinking about it as, okay, I've got money to do anything I want to do, right? Where it might just be like, I'm going to have to make some lifestyle choices that I can live with that will then maybe bring down the burden of how much money I actually have to have there. And the reason why I'm harping on this is, obviously, if the millionaires are losing confidence, everybody else is losing confidence even more, right? Just simple math. But let's assume that Felix Zulauf is right here, right? And that we head into a future in the not too distant future where we just have a structural higher inflation rate because we're in this new bifurcated world, right? That has more persisting supply push inflation, cost push inflation. Then we have the central banks intervening and bringing rates way down again, right? So all of a sudden, you get no yield off your bonds in retirement, right? And that stimulus is just going to spark demand push inflation as well, right? So cost of living is going to, if we think it's bad now, it's going to be increasing even faster, right? So you get in this future all of a sudden where the cost of living just keeps jumping, at a higher and higher rate, and your ability to earn a safe return potentially gets compromised if interest rates get throttled back to the same lows that they were at before.
Yeah. No, that's absolutely right. And that's going to be the problem that individuals have, over the next decade. But that's why we manage money. And that's why it's so important to make sure that you have your plan and you understand where you're headed and make sure you're saving enough to get there.
All right. Well, we'll have to leave it at that for time's sake. Lance, thanks so much for yet another great week. Everybody else who's watching, obviously, I think we, continue to beat our drums on why getting some good financial help to help navigate all these issues, both where the markets are headed, but also helping us, reach our retirement goals, et cetera. It's always pays to have a good financial advisor who can help be your coach through that. If you've got a good one, great, stick with them. If you don't, consider talking to one of the ones that Wealthion endorses. You get to meet with them for free. They will review your entire personal financial situation and give you their best advice. You can use it with your existing financial advisor, you can do it yourself, or you can continue talking to these guys. It's just a public service they offer. To go set yourself up for one of those, just go to wealthion.com, fill out the short form there. And again, if you enjoy these weekend market recaps, even to scintilla as much as Lance and I do, and you're also hoping that my voice is better for the next one, so you don't have to listen to me croaking, please do us a favor and hit the like button, and also click on the red subscribe button below, as well as that little bell icon if you haven't done so yet. Lance, it's been great, buddy. All right, everybody else, thanks so much for watching.